All right, let's talk about the homebuilder Lennar. Their latest earnings report just sent the stock tumbling. And the real story here is a classic high-stakes dilemma. Do you chase sales or do you protect your profits? Well, Lennar just showed us which side they picked, and it's clear the market wasn't exactly thrilled. So let's dive in and see what happened.
Okay, so here's our game plan. We'll start with the market's immediate reaction. Then we'll get into the actual numbers. After that, we'll unpack the core drama of the quarter, this tug of war between margins and sales volume. Then we'll cover what management's thinking now, and we'll wrap it all up with our take on what to expect for the next call.
So, first up, the market's verdict. Before we even get into the nitty-gritty of the numbers, let's look at that knee-jerk reaction from investors. Because let me tell you, it was swift and it was decisive.
Bam! The stock dropped 4.2%. Now, a drop like that isn't totally unheard of, but what really tells the story here is the volume. We're talking 4, maybe even 5 times the average daily trading. That's not just a few people getting nervous. That's the big institutions hitting the sell button hard. So the question is, why? That's exactly what we're about to unpack.
Okay, on to the headline numbers. Let's pull back the curtain and see the exact data that fueled all that negative sentiment.
And right away, you can see the problem. Core earnings per share, or EPS, came in at $2, but Wall Street was looking for something closer to $2.11. And it wasn't just earnings. Revenue missed too. You know, when a company misses on both the top and the bottom line, that's a tough pill for investors to swallow right out of the gate. Now, if we dig a little deeper into the key metrics, this is where the plot really thickens. Home deliveries, pretty much flat. No big surprise there. And new orders? Hey, that's actually a bright spot, up a solid 12% year over year, which beat expectations. But, and this is the big but, just look at that gross margin. It fell all the way to 17.5%. That's not just a miss, that is a collapse from 22.5% a year ago. And folks, that right there, that's the real story of the quarter.
Which brings us right to the central conflict of this whole earnings report: margin versus volume. This was the tough, strategic trade-off that management had to make.
I mean, just look at this chart. We're talking a 500 basis point drop. For those of you who don't live and breathe this stuff, that's a full 5 percentage points wiped off their gross margin in just 1 year. That is a huge deal, and it's the #1 reason they missed earnings and the stock got hammered. So you have to ask, did this just happen by accident, or was this a deliberate choice? Well, we don't have to guess. Executive Chairman Stuart laid it all out on the conference call. He basically said, yeah, we did it on purpose. They had to throw a ton of incentives at buyers, things like buying down mortgage rates, just to keep the sales engine running in a tough market. And as he says right here, those sales came at the direct expense of their margins. So there you have it, the trade-off in black and white. That impressive 12% growth in new orders, it didn't just happen organically, it was essentially bought and paid for with profitability. Management made the call that moving houses off the books was more important than making a bigger profit on each one.
Okay, so they pulled the lever on margins to get the sales volume they needed. What's next? Well, now we're getting into what management is calling a pause. Let's look at their guidance for next quarter because it tells us a lot about their new game plan.
All right, looking ahead to Q4, deliveries look solid, new orders a little softer. But the number that made everyone on Wall Street really sit up and take notice was the gross margin guidance. They're forecasting about 17.5%. What they're signaling is, okay, we're drawing a line in the sand right here. This is the new floor for profitability, and we're not going any lower. It's a pretty conservative stance. And naturally, this leads to the million-dollar question that every analyst was thinking. Wait a minute, you just spent an entire quarter flooring it to drive sales, sacrificing margin to do it. So why are you suddenly hitting the brakes now? What's the logic behind this pivot? And once again, Stuart was very direct about it. He's framing this as a strategic pause. He says it's not a retreat, it's a recalibration. The thinking seems to be that they've pushed as hard as they can with incentives. Now it's time to hold the line on profits and basically wait for the market to come to them, hopefully in the form of lower mortgage rates.
All right, so with all that context, where does this leave the stock? This brings us to our final section, the next call. Here's our rating, our forecast, and even a potential trade idea.
So here at Talk Tickers, we're rating the stock of market perform, and here's why. On the plus side, by setting that low bar for margins, they've kind of de-risked the next quarter. The bad news is already baked in. But on the flip side, those same margin pressures are going to act like a ceiling on the stock price. It's really hard to see a lot of upside here until the overall housing market improves. So when that Q4 report drops, here are the 3 things you absolutely need to be watching. Number 1, mortgage rates.
Do they fall enough to boost demand so Lennar doesn't have to rely on incentives? Number 2, margin execution. Can they actually defend that 17.5% line in the sand? And number 3, operational efficiency. They're building houses in a record 126 days, which is incredible. They have to keep that up to fight off other cost pressures.
And that brings us to a potential trade idea. In a challenging market, you often want to bet on the best-in-class operators. So one idea could be a pairs trade. Go long on Lennar stock, while at the same time shorting the broader homebuilder ETF, which is ITB. The thesis here is that Lennar's huge scale and operational discipline will help it outperform its smaller, less efficient peers, creating value even if the whole sector is struggling. So there you have it. That's the story of Lennar's quarter, a calculated sacrifice of profit for sales followed by a strategic pause. The company is now in a holding pattern, betting that lower mortgage rates will come along and reignite the market. It really all boils down to this. You have a patient home builder versus an impatient market. The big question for next quarter is, who's going to blink first? As a final reminder, this is not financial advice.